welcome. You have Happy, my real name's not Happy, my real name's Laura. And we have Monique, my partner, my fiance, my better half. And we're still waiting on some other people. So we'll just give it a minute. I hope everyone's having a great day. What day is it today? Today's Wednesday. Every day feels like it's the same day. Every day is a Monday for us, right, Monique?
Yep, absolutely.
Every day's a Monday.
Gotta love it.
Yeah.
All right, we're waiting on a couple more people. Laura, can you make me a moderator so I can move people up and down?
Of course I can make you a moderator. Make a moderator, and I will make Jonathan, aka J-Lou, a moderator too. Yes, I'm sure. Oh, I don't follow you, J-Lou? I'm sorry. Dang.
What a burn.
I'm pressing follow. I just pressed follow. Can we just talk about GameStop during this whole thing? I'm kidding. I'm joking.
Let's talk about GameStop every day.
Yeah.
It seems to never be over. I'm always shocked and surprised and amazed.
Exactly.
Thank everybody for joining us today for our weekly session of Money Talks, Personal Finance and Investing for Beginners. So Laura kind of gave us a little intro earlier. Laura and I actually host a personal finance.
Trash cans to the curb.
We really need to turn off that Alexa alert. It's gonna go off. It's gonna go off during this time period every day. But yeah, so Laura and I host a personal finance YouTube channel. It's called Finance Pillow Talk. And we've just gathered a group of our close friends who also happen to be, just really good in the personal finance and investing space to just talk about some of these topics. There they are. Hey, Ben. Hey, Oliver.
Hey, guys. Sorry about that. Was finishing up dinner.
Yeah, no worries. So last week was actually our first session for this room. And so last week we talked about, what questions should you be asking yourself when you first start investing? Exactly what is investing, why you should start investing, and then, kind of some of the arguments that people usually give as to why they're not investing. And we kind of debunked each of those. And then after that, we also talked about how do you determine what type of investor you are. So that's kind of what we talked about last week, just a quick recap. And then this week, some of the things that we're going to be going over are, just some of the common definitions that every investor really needs to know. I mean, we're gonna dig into some more complex stuff later on, but we really wanted to keep it simple today and go over these definitions because if you don't understand these definitions, you're really going to struggle understanding some of the stuff that we're going to talk about later. So we wanted to make sure that everybody's on the same page. So that's why we're starting with that today. And then after we go over some of these definitions, we're going to talk about, setting financial goals. And then after that, we're going to do just some Q&A. So we are planning on putting this discussion on YouTube or, maybe some sort of podcast thing later so that everybody can listen to it in case they, don't get a chance to get to this session. So please let us know if you consent to having yourself recorded, because I know there's a lot of gray areas here in Clubhouse about whether you can put this up later or not. But if you don't want to be recorded, that's totally fine, no problem at all. Just let us know, and we'll cut out that portion of the recording before we post it anywhere. But before we dive in, I do want to go around and have each speaker just tell us a little bit about who you are and your experience in the finance world. And speakers, of course, like I just mentioned, can you please also just say at the beginning whether you are okay with being recorded, whether you can give your consent as well. So I'll go ahead and start off. We'll just go in alphabetical order. Can we start off with Ben? Tell us about yourself.
Hey, guys. You have my consent to record. So hi, my name is Ben Abeto. I live in Austin, Texas now, and a quick background on me, I'm the Chief Strategy and Revenue Officer for a privately operated toll road. It operates east of San Antonio and Austin. I am a former Bain & Company management consultant, and I've also worked in investment banking and venture capital space. Sorry, a little nervous. Weird. I received my MBA from MIT, and I'm also a former U.S. Navy officer and kind of new to the personal investing space. I had previously relied mostly on my TSP and index and passive investing, but have recently started kind of dabbling on my own.
Man, Ben, I don't know if we should have started with you. I don't know how we're going to follow that. MIT from MBA. I should have put you last. Okay, next time we do this, I'm putting you last because you're going to make us all look bad.
Seriously? And I have to go next? Thanks,
yeah.
man.
All right, I'm sorry, Jaylu. You've got to follow that. All right. So, yeah, next
Well, Jaylu's prettier than me, but the Clubhouse platform doesn't help him out on this one.
Hey, guys. My name's Jonathan Liu. Used to be a financial planner for Fidelity. Went to UT. Man, that's all I got, guys.
All right.
I guess currently, I guess I left Fidelity, it was like 3 or 4 years ago, and now I just manage investments on my own. Yeah, that's pretty much it.
Awesome. Thank you, Jonathan. All right, Laura, tell us about yourself.
Hey everyone, I'm Laura. I'm a manager at Ernst & Young, which is a Big Four company. I work in the M&A group where I work on like tax structuring and due diligence. The majority of the clients I work on like in the private equity and SPAC space. I got my master's in accounting at the University of Texas at Dallas. And I've had my CPA license for about 6 years now.
Awesome. And you're also my fiance. Thanks, honey.
Yes, and her fiance.
All right. So my name is Monique, and I'm actually just a pharmacist, and I work in a hospital here in Houston. I am obviously the least financy type of person in this room. I did take some intro economics, accounting, and finance courses when I was in undergrad at UT, but I'm definitely very much just a normal person compared to everybody else in this room. I really just started reading and learning a lot about investing after I graduated from pharmacy school, which was in 2014. And, ever since that time, I really just enjoyed everything I read. I totally became obsessed with it. And I just really love sharing everything that I've learned because I just feel like this topic is so important and they really don't teach us anything about this in school. And it's just like, this is such a huge part of your life. So I just love sharing what I've learned. And that's, a big part of why we started our YouTube channel, is that we just thought everyone deserved a chance to learn about investing and personal finance. And, I didn't think you should have to pay a personal, a financial advisor a lot of money to do it. So that's who I am and that's why we're here. But I'll go ahead and pass it on to Oliver.
Hey, what's up? I'm Oliver. So I am a institutional trader. Been doing this for about 14 years. First job I've had out of college, and basically the only job that I've had. Now I manage multiple books, varying strategies, all pretty aggressive, like totaling buying power in the tens of millions. So yeah, I've just my expertise is in trading.
Oh my gosh, and even though I said it earlier, I totally forgot to say it. I give my consent to record myself.
Consent?
Jonathan, are you okay with us recording you and posting this later?
Yes.
All right, thanks guys. We're still learning. Okay, so today's conversation, like I said, we do want to go over some basic definitions. We're just going to keep it nice and easy, but we're going to start off with, just stocks. Like, what is a stock? So I'm going to hand it over to Oliver, our, stock expert in the room. So Oliver, tell us about stocks.
All right, so stocks, if you break it down, it's just basically a piece of ownership in a company. There's usually a common stock, preferred stock. You can also get into stock warrants and other things. But for our purposes, typically when anyone says they're buying a stock, they're talking about common stock. Common stock gives you, like I said, partial control of the corporation. You get voting rights, basically like one vote per share if you ever want to vote. Most people don't. They just do a proxy. They default it. You also lay claim to dividends if the company does give you dividends. But it's essentially just a piece of ownership, and it's one of the best asset classes to own. Is like you probably get more appreciation in this asset class than any other asset class out there. But yeah, that's generally it. It's pretty straightforward.
Perfect. Thank you, Oliver. All right, next up, we're talking about bonds and CDs, and I'm going to hand it over to Ben to talk about those.
So bonds are, instead of shares of company, they're basically IOUs to companies. So companies will issue bonds as a way to, make investments in the company. Typically, if it's for a corporate bond, they've got some project that they want to finance. If it's a government, they want to, provide some good or service to the public. If it's a municipal government, it's typically a capital expenditure such as a road or a school that they want to pay for. And so what a bond does is the government says, hey, let me borrow some of this money, and periodically I'll give you a small payment, and then at the end of a given term, I will give you back what you gave me in the beginning. So it's a lot safer than a stock. It exposes you to a lot less risk, because if the government doesn't make enough money, they aren't going to really go broke, so they'll still be able to pay you back. Unlike a company with a stock, if they go bankrupt, you basically lose all of the principal that you put in. With a bond, even if a company goes bankrupt, they still will have to pay you back ahead of any of the equity shareholders. So again, you have less risk, but again, you also have less upside if a company does really well.
Something I would add is also how large the bond market is. I just looked it up, and currently it's at 100 trillion. And to kind of give you an idea of scale, the stock market is at 68.65 trillion. So it's actually quite a bit bigger.
Right.
Yeah.
So what about CDs? Can you tell us a little bit more about that?
Yeah, so CDs, you pretty much explained it the same way as a bond. I think Ben did a great job going over the bond area. But CDs, it's the only difference is usually it's a financial institution. Most of us are probably more used to hearing it about, like if you go to Bank of America or Chase and you just want to put money in, you can, buy different durations just like bonds. And depending on those durations, those are going to give you a different interest rate as well.
Perfect. And I know, so another really important concept that we have to cover if we're going to talk about bonds and stocks and all this sort of stuff, and especially right now, it seems to be a very important topic, is inflation. And I know we kind of touched on it a little bit last week, but I think especially during this time period, it's really important for everyone to really understand inflation and how it works. So Ben, can you tell us a little bit more about that?
Yeah, I think inflation is an important one. Inflation basically is a measure of your purchasing power. How much can you buy goods or services with your dollar? As you can all imagine, typically over time, you will see positive inflation, which means that a certain good or product, a Big Mac or a Coke, 1 year will be more expensive another year. And this typically happens because the economy is doing well, people are making money, and they're willing to pay more for a certain good, and there are only certain good, there are only finite numbers of goods around, and so typically people will be willing to pay more for something. And I think it's important now because there are other factors that influence inflation, and one of the big things in the news now, we're pumping. The government is putting $1.9 trillion of stimulus into the economy, and so the thought is, well, you're putting a lot of dollars into the economy. Is that going to cause prices to go up because people have more money to spend on those finite goods and services?
Right, exactly. And I think, it's not just the typical goods and services that you're thinking of, like your can of soda or whatever. I think we're seeing it a lot, even in the housing market, right? Like everything's supply and demand. If you don't have enough supply of something, then you're going to start to see these prices going up. So we're seeing this a lot already in some of the markets. But yeah, so really important for everyone to just get a general understanding of this concept. But thank you so much for explaining that. And then I guess...
Yeah, I think I'd add one more thing. So another part that's really important about inflation is when we talk about bonds or savings accounts, they typically are operating under a fixed kind of interest rate that is set at the beginning of a term. And so if future inflation rises more than you would expect, it actually starts to eat into the expected return of that asset, right? So if I had a 2% bond and I only expected 1% inflation, but in the future we actually get greater inflation at 2%, that means I just wiped away all of the return of that bond that I expected.
Yeah, absolutely. So, and I think anyone that's been following the news or following the market, all this talk about bond yields and the treasury yield and all that stuff can get super confusing. But yeah, a big part of it does come down to, inflation. Do we think inflation is going to happen? So we could probably talk about that for a really long time, but I'll try to move on just so that we don't get stuck on this one topic. But absolutely, that is such an important topic, and we could probably do an entire episode on just inflation and the bond market. But for the sake of time, we'll go ahead and keep it moving on to the next topic. So next, we wanted to talk about mutual funds, ETFs, and index funds. And so you may have heard all of these things, and they all sound pretty similar, and they can get pretty confusing. So we really wanted to break down each of these so that you get a complete understanding of, what the difference is and what the similarities between each of these things are. So I'm going to hand it over to Laura to start off this discussion.
Thank you. I was patiently waiting. So we're going to start, so we're talking about mutual funds and exchange-traded funds. So Monique was talking about the similarities, and the similarity is that they both have the word fund in them. So both of these are pools of securities, right? So what is a security? A security is defined as proof of ownership or debt that has been assigned value and may be sold. So basically, it's just pools of stocks and bonds. There are other things that you could have in a fund, but that's probably the majority of what you might see. So the next question is, how are they different? So an exchange-traded fund is traded like a stock. It can be bought and sold throughout the day as long as the stock market is open. So that's why they're called exchange-traded funds, because they're sold on a stock exchange. And I'm sorry if this is more like explained like on 5. But so whereas mutual funds are only traded at the end of the trading day. So the market is open from 9:30 to 4 p.m. Eastern time. So if I wake up and notice that the market is crashing, even if I put in my sell order at like 9:30 a.m., my mutual fund will not be sold until the end of the trading day. So furthermore, mutual funds and ETFs can either be actively managed or passively managed. And so this is kind of the next topic here. So an actively managed fund has a fund manager that studies the market, does research, picks stocks, and tries to time the market, so either buying low or selling high. Whereas a passively managed fund does not try to beat the market. It simply tries to match the market. We know that overall the market goes up over time. So by just matching the market, the passively managed fund will still profit.
Yeah, and so one of the most common types of passive funds is the index fund, and I'm sure you've probably all heard this term before. So an index fund, it is a fund, like we mentioned earlier, so it is also a pool of securities. So the difference here is that this fund tracks an index. So what exactly is an index? An index is literally just an imaginary basket of securities that's intended to replicate a specific area of the market. And one of the most well-known indexes is the S&P 500. So the S&P 500 is just a list of the 500 largest companies in the U.S. So you can have an index mutual fund, or you can have an index fund ETF. And the main difference between those is really just how and when they're bought and sold, like Laura said. So, mutual funds only being able to be traded at the end of the day versus your ETFs, which you can buy and sell at any time that the market is open. So now that we kind of know some of the definitions, let's talk about some of the pros and cons of each of those, right? So one of the most important risk mitigation strategies in investing is diversification. And basically that just comes down to just don't put all your eggs in one basket. If you were to put all your money in oil and gas and then oil and gas crashes, you're going to go broke. And even right now, like we're seeing a lot of the tech sector, if you had put all your money into Tesla and all your money into Apple, like you might be in a little bit of trouble right now, because right now that sector is not doing as well as maybe some of the others. So that, that's just an example. So just don't put all your money in one place. And so by spreading out your investment into different areas, you're able to protect yourself in case any one of those one areas crashes. So the reason that index funds, mutual funds, and ETFs are so popular is that they allow you to be really highly diversified really quickly. And you can also do it with a pretty small amount of money. So for example, you could pay a few $100s for one share of an S&P 500 index fund. And then instantly, by buying that one share, you now own a small piece of those 500 different companies. I mean, you could definitely still do this on your own without an index fund, but it would take a lot of time and, maybe a lot of money. Like, do you want to go and individually buy 500 different stocks of these companies? So that's the main thing. It's really convenient to be able to buy this index fund, saving you a lot of time. And then one other really big advantage that ETFs have over mutual funds is taxation. So due to how they're constructed, ETFs incur capital gains taxes only when you sell them, versus mutual funds incur capital gains taxes as the shares within the fund are traded throughout the life of the investment. So it's a little complicated in terms of how that works, but really just you get a little bit of tax savings when you use an ETF over a mutual fund. So that's one of the other benefits.
I would say that it depends on the ETF. I think originally when ETFs were created, they were more used as index funds, in which case the taxation portion would be correct. But I think more recently, like for example, the Cathie Woods ARC funds, those are, I believe, are going to be active managed. So I'm not entirely sure if those are going to be have the same tax benefits as, if you were to invest in like the S&P 500.
So I think that's more so like their expense ratios. Obviously, like the active funds, like the ARC Cathie Woods funds, are going to have way higher expense ratios than your typical index fund. So I think the ARC funds are like 0.75% or something, and then just like an S&P 500 might be like 0.03%. But from what I've read, I think it's like just specifically how things are bought and sold within those different types of funds. They have a slightly better, tax structuring.
Benefit. Perfect.
So to just kind of want to cap off this topic. So basically, mutual funds can only trade at the end of the day, so they're considered less liquid. ETFs can be traded at any time, so they are more liquid. So if you're an active trader, you're going to want to use ETFs. ETFs may also help, just talking about tax, ETFs may also help lower your tax bill. And at the end of the day, the thing that may make the biggest difference is whether the fund is actively managed or passively managed, and the fees that the fund is charging.
Right, exactly. And that definitely goes along with what Jonathan was just saying about the different expense ratios. So you always want to pay attention to those fees because they can make a big difference. One of the other possible downsides of index funds is that, if you're buying the S&P 500, even though these are the largest 500 companies in the US, that doesn't necessarily mean all of them are going to continue to be great in the future. So you may get some bad apples with with the good as well. And then at the same time, you're probably not going to see the same like crazy growth with an S&P 500 fund or another index fund that you might see if you had just bought a share of Tesla or had just bought a share of Apple or something like that. So you are diversifying by having these index funds because you are able to buy so many different shares of companies at one time, but at the same time, you're also kind of limiting your growth as well. But as we mentioned, with funds, that is a huge benefit. That diversification is really going to protect you in the long run. But yeah, so that's pretty much it. Mutual funds, ETFs, index funds, they all offer instant diversification and convenience. Like Laura said, ETFs are going to be more liquid than mutual funds and can help you pay less in taxes. And no matter which of these you choose, just make sure to pay attention to fees, which are also known as expense ratios. So if you hear expense ratio, just think fee. But yeah, so that covers that topic. And
as a general rule, if the higher the risk, the higher the reward. Lower risk, lower reward. So yeah, that's the basic benefit of diversification.
Yeah.
Additionally, like with those index funds, the funds are changing every year. They go through what's called rebalancing periodically. So like the S&P 500, if you have a really poor perform, like number 500 is really poor performing, you have some like new superstar company that was in the mid caps. Oftentimes you'll see something from the S&P 500 drop out, or one or two, and then something from the mid caps come up into the S&P 500 to replace those.
Yeah. Ollie, correct me if I'm wrong. Also, just to correct the thinking is within the S&P 500, it's not buying one stock of each of those companies so that you have 500 stocks of each of those to represent the index. It's actually in proportion to the size that they represent within that index, within the S&P 500.
Right. So it's the weighted. It's weighted to like Apple or like Microsoft or Facebook.
Market capitalized.
Yeah. So those, you'll be actually buying more of those. So it's really the largest companies. In theory, it's the strongest companies. You'll get appreciation through those. So as those companies grow like larger and larger, then the S&P 500 technically has to own more of that than the lower ranking ones. But there are other options. If you want to be more balanced, it's like an equal weight index where you literally are basically getting an equal percentage of each S&P 500 or Russell or NASDAQ or whatever index that you're buying into.
Yeah, thank you so much, Ben. That's a really good point. And I think that's something that a lot of newbie investors probably aren't familiar with. That some of these funds are going to be weighted, like Oliver said, and some others are going to be more equally balanced. So that's another thing to keep in mind as well. But yeah, great. So moving on to our next kind of definition that we want to talk about. So let's talk about savings accounts and money market accounts. And I'm going to hand it over to Jonathan for that.
Perfect. So savings accounts, money market accounts. I know this one is pretty much used by everybody. I think you should have a savings account, before you even have an investment account, just simply because, like we kind of talked about last week, you want to have roughly a year's worth of emergency funds before, kind of putting anything at risk. So to talk about them, savings accounts, we should be familiar with them. They're going to be at most of the banks. You can get them at credit unions. You can also get them, at the newer online banks. I believe those pay higher interest rates than probably the more popular banks. The other option is going to be money market accounts. I know at Fidelity they use money markets as their core position, which is pretty much where your cash sits. While I was in the industry, we weren't allowed to say, like money markets don't lose money. But something that I would say or tell clients would be during, the 2008 crash, these money market positions didn't lose any value. So they're really safe. They generally are going to pay very low interest rates. I know for banks, generally savings accounts pay 0.1. If you're, like high net worth or super high net worth, you might get 0.5 or, maybe 1%. I don't think I've seen 1% on savings accounts, but money market accounts, those can reach 1%. But you also have to be pretty wary about, depending on what kind of amount that you're investing in. So you can get money markets that are going to be tax-free, and you can actually get some that are right at around 1, maybe 1.2%, around there. Let's see. So some key takeaways. When you buy stock, you're buying a piece of a company. When you buy a bond, you're extending a loan to a borrower. And when you buy a mutual fund or ETF, you're getting broad exposure to different parts of the market. And I think that's pretty much it for the short-term investments there.
Perfect. All right, so that kind of rounds out our definitions for the day, and I really hope that you hopefully got something out of that conversation, because like I said, we are going to talk about some more complicated stuff as we get further into these discussions. But yeah, absolutely, if you don't understand some of these basic definitions, then moving on beyond that is difficult. So our next topic is going to be setting financial goals. And I think a lot of people, when they think about investing, either they're thinking about, oh, I just need to save for retirement, and that just feels so far away. Or maybe they're on the other end of the spectrum and they're like, I just want to buy GameStop and make it rich right now. And there's a lot of stuff in between those two things. that you may or may not be thinking about. So I'm going to hand it over to Jonathan a little bit to talk about, how to set financial goals, kind of what some of those different time frames might look like, and what some of the examples of those different types of goals may be.
Awesome. So, yeah, we talked or brushed on this a little bit last week. I'm actually going to go backward because I think it'll flow a little bit better. But we'll start off with like long term. So if you have a financial goal that's long term, generally you're going to be heavier in the stock region. Almost always want to have an allocation in bonds, but usually that bond position is going to be quite a bit smaller, simply because you have a longer time horizon. And the longer time horizon that you have, you want to have more equity exposure or stock exposure, just because it will grow faster than if you had a portfolio full of even 30-year bonds or anything like that. Some things that would be considered long-term, they're going to include retirement, maybe saving for a home or a vacation home, and one that a lot of people are saving for now would be college savings. Long-term financial goals are going to be anywhere 10 years or more. So long-term, you definitely need to have a lot of time just in case, the market downturn. You don't want to have to be pulling or withdrawing funds when the market's down. So if we move into midterm, I think last week I said it was like 3 to 5 years. So midterm is actually 3 to 10 years. And your investment allocation can actually vary depending on that 3 or 10 years. So if you're closer to the 10-year area, then absolutely have, heavier stock allocation. But if you're at 3, then, you might want to have maybe a 50-50 split. Those midterm goals might be, things like buying a car, or if you're getting closer to actually going to college. Finally, short term, we talked about this just now. That's going to be a time frame of 1 to 3 years. But usually in a short term time frame, you're going to hold more CDs, money markets, high yield savings, government bonds, or treasury bonds. That's because as you get closer to your goal, you don't want a whole lot of fluctuation in your portfolio because you're getting ready to spend those funds. Just like we talked about in midterm, if you're going to be withdrawing those funds, you don't want to be pulling it out when the market's down and, you've lost money on that investment. So it's better to be safe and stick it into something that is going to be relatively riskless.
Yeah, thank you for that, Jonathan. And I think as an early investor, like I mentioned earlier, I didn't really think about some of these other types of goals. Like I was really just like, okay, let me just stick money into my 401k and that's it, and I'm just saving for retirement. But I think as I've learned more over time, I've started to realize like, I can use stocks to achieve some of these other goals as well. It may not be like, I should put 100% of my money to save for a house or save for, a vacation home or whatever, but just realizing, like having that mindset of like, okay, investing is not just for these very specific goals of like just retirement. Like there's a lot of other things that you can use investments for. And even like, I think some of the brokerages are getting better at helping people see that. Like I started off using Betterment, which is just like a robo-advisor. And some of the things that I've noticed over time with them is like they have something called like a safety net fund, which is, essentially a replacement for like emergency savings, right? So just another option instead of just doing a typical savings account. And I think when I first opened up that savings, safety net thing, I think their allocation was something like 15% stocks, 85% bonds, or something like that. But I thought that was just really interesting that like, even though it's just an emergency savings, and my initial thought of emergency savings was always like, it has to be just a savings account or some cash. But yeah, like you can use these investment accounts to achieve those types of goals. You just have to allocate your assets differently. So I thought that was a really interesting thing. And you can apply that concept to a lot of other things. Like Jonathan was saying, like whatever your goal is, whether you're saving for your kids' college savings or whether you're trying to save for a car or you want to buy your first house, it really just comes down to like how much time do you have until you want to reach that goal. And then you can create these accounts with different types of asset allocation with like different percentages of stocks and bonds to achieve that. And I thought that was really neat. But Yeah.
I think you hit on a good point, and I think our generation benefits from having a lot of these tools at our disposal. I think some of us may be, I guess, more maybe more apt or maybe more aware than others. I know when I started, getting the lessons learned from my family. It was really, we have a pension, we don't have to worry about it. And nowadays we're moving away from kind of defined benefits to defined contributions. And so a lot of times early on, when you're a first generation, you end up maybe not knowing that these tools are at your disposal. So just for example, I was in the Navy right out of college, and I had started my retirement fund, which in the Navy is through the TSP. And for the first 4 years, everything was going to the G fund, which lo and behold is just government bonds. So I was earning, 1 or 2% for those first 4 years. And that was huge because I was not exposed to, the stock market, which is, on average 9% return per year. So some of those tools like Betterment are a great kind of educational tool for young people, to know the benefits that are at their disposal.
Yeah, that's such a great point, Ben. Ben, I'm sorry that you were stuck in that deep pond for so long. But yeah, I mean, we all make mistakes as we're learning, right? Like everyone has to start somewhere. And I think a good takeaway from that is like, yeah, we may have done something not perfectly when we first started investing, and I'm sure each of us has some story along those lines. But at least you were doing something. At least you were putting your money somewhere, even if it was only earning 1 or 2%. Like that's still better than having it just sit in cash. And then, yeah, as time goes and you started learning more, then you're like, oh shoot, like let me do something else with this money.
Exactly.
But yeah, like we've all had those stories. We've all made mistakes, and I think a really important point with investing is that you don't have to be perfect, right? Everyone's going to make mistakes, and even professionals, even people that do this every single day, day in and day out, they're going to make mistakes. Like you just cannot have a perfect record. So I think the biggest thing is just keep learning and keep adjusting your strategy over time as you learn more. And even if you feel like you don't know anything, like some of us did in the beginning, there's still easy ways to get started. And even if you don't pick like the perfect brokerage, like everyone's like, oh, what's better? Is it Vanguard, or is it Charles Schwab, or is it Fidelity, or is it Betterment? Like I hear that all the time, like which one should I go with? And honestly, like any of them are fine. At this point, I think they're all so similar. Like you may have slight variations between one or the other, but right now, like pretty much trading is free on any of these brokerages. So, it's not going to make that big of a difference at the end of the day. So if you really are just stuck and you don't know which one of these to go with, like just pick one and it's gonna be okay. And if you find out later that it wasn't the right choice, or like you like something else better, that's okay too. And you can still like I said, I started off with Betterment, and then I kind of like outgrew it a little bit as I started learning more over time. And then after that, like I opened, a TD Ameritrade account or a Robinhood account, and like as I learned more, I like moved on to these other things, and I still have my Betterment account that I had from day one. And so it's okay to like start off with something and move on to something else. And yeah, you just don't have to be perfect. So I want everyone to keep that in mind too.
To add to that, look, yeah, like the earlier you start, the better it is, because you can't make those mistakes. And honestly, I do encourage you to make those mistakes, because when people talk about like trading with the practice accounts, a lot of times we just tell people just jump right in and like start trading. I mean, like be careful with it, obviously, and that's the point of diversifying. But there's no better teacher than pain, unfortunately. So, and then to an earlier point of view is just like everyone makes mistakes. Like I've told everyone I make probably 10, 20 mistakes a day. Or I'm wrong 10 or 20 times a day. But in the end, you hedge your bets, you diversify, and overall in the long run, like you should come out on top. As long as you focus on, not getting too concentrated in anything, and focusing on investing in the best companies out there. products that you buy, and just like well-known established companies.
Yeah, well, thank you so much to all of our guests. Like, that's all we had planned in terms of our specific topics. But now we're going to just go ahead and open it up for questions. And again, just for the sake of time, I want to let you guys know that after your question is answered, I am going to move you back into the audience. But please don't take it personally. It's really just to make sure that we stay on track in terms of time. And I do want to respect all of the speakers' times as well as everyone in the audience. So just letting you know now, I am going to move everyone back into the audience after your question is answered. And again, when I bring you up, please let us know whether you do give your consent to have this recording posted later. And again, if you don't want to be recorded and posted later, that's absolutely okay too. Okay, so I'm going to go ahead and start opening it up to questions. Okay, hey Chi.
Hi, Monique, how are you doing?
I'm great, how are you?
Good, thank you. Yeah, just a quick questions about you guys talking about stock. Are you guys talking about single stock, or you guys talking about stock in mutual fund in general?
What do you mean? Are we talking about single stocks or? I mean, this entire discussion was really just definitions. So we were talking about what is a stock in general, and then we also talked about what a mutual fund is in general.
Correct. So like I know Oliver was talking about how you were saying you're buying stock, all these different things, right? So I put my money in my mutual fund for the most part. So most of them are stock, which is pretty aggressive. So that's how I look it. That's how I prepare for my retirement. I don't do single stock. So I don't know if you guys actually do single stock in general. Like, you just go to buy GameStop. Or you buy Google.
Oh man,
we all went and bought GameStop.
GameStop.
No, I'm just kidding.
It's too late now, right? GameStop.
Really, who knows? But that's like, even we were talking about this today at one of my coworkers. It's one of the hardest, at least for trading purposes, one of the most difficult stocks to trade right now because there's so many eyes on it and it's so volatile. So if you believe in the company, like, fine to allocate some into it, but buy into it and hold on for the longer term.
Yeah.
I think Mo touched on this earlier, and definitely Ollie and Jay Lou can speak to it. But on average, if you look at the performance of an individual professional stock picker, they are not going to beat the broader S&P 500 over a 10 to 15 year time frame. It's very difficult. So that said, if you are passionate about it, you believe in your ability, more power to you. But if you don't have that time, don't have that ability, you should probably limit your exposure to stock picking to a smaller portion of your overall portfolio.
Yeah, so for my portfolio is like 2% of my portfolio, just basically just to play around with my stock. But for the most part, 90% of them are all in my mutual fund, 401k, Roth IRA, all the different things. Yeah,
that's actually the best way to learn. Really, just allocate that small portion. See how these stocks move. How quickly you can make money or lose money, and then keep doing.
Yeah. So the thing about picking stock for me, anyway, right, is I have the temptation to just take it out. Mutual fund, I don't really have that choice because I know it's really for long haul. So you can't let it sit for 10, 20, 30, 40 years. So by doing that, your compound interest is going to help you to grow the money, right? But with the stock, you just I make $2,000, I'm going to take it out. But then you still pay taxes,
It's like the main thing we always say, like, when you're in the casino, you want to play. And there's like a lot of people when they treat the stock market as a casino, it sounds sexy, you can make a lot of money. But the majority of people only think about how much they can make, and they don't think about how much they can lose. And I always harp on this. I'm a big proponent of risk management, and trading specifically as a profession. We have a 95% first year failure rate. So that adds to what they were talking about earlier. How most people don't over the long run can't even match like a passive fund, but traders specifically, first year failure rate is 95%.
Okay, thank you.
Yeah, Chi, I think some of the other speakers have already mentioned it, but I think it really comes down to, how much do you want to learn about investing? I think if you're still a beginner, for most people, I would recommend sticking to funds, whether that's a mutual fund, ETF, or index fund, just because you're still so new and you're learning about so many things. And if you do want to have like a small percentage, like your 2% or whatever that you want to play around with, and invest in like some companies that you're interested in, I think that's okay. But again, do think about it as a more risky investment at that point, because you are still learning. And then maybe as you learn more and you start learning how to learn about the fundamental analysis of different companies, and you do start just reading more and learning more, then maybe you can start to increase that allocation that you have to individual stocks to being, a little bit more. And then another big thing is just, what is your risk tolerance? If you're someone that just absolutely cannot handle like big drops, like if your stock dropped 30% in one day and you're the type of person that's going to freak out and sell it immediately, then, I would probably tell you like individual stocks might not be a great idea. But if you're someone that can handle that sort of thing and you're okay with it and you can keep your cool, then I think, yeah, maybe that would be something okay for you to do, and put a little bit more into individual stocks. But it's really just going to be different from person to person, just like everyone has a different personality. Like the way you invest is going to be different. And I think, yeah, beginners are probably going to have a lot more funds and like fewer individual stocks. And then people that are more experienced may have slightly more individual stocks just because they've learned more about it over time. And then, but even people that are super experienced and have been investing for decades, they may still just want to do nothing but funds because they just don't have the risk tolerance for it. They don't want to worry about the stock market. They don't want to be looking at their portfolio and worrying about, oh my gosh, is it going to crash today, or whatever it is. So I think it comes down to your experience level and what your risk tolerance is as well.
Thank you.
But yeah, oh, sorry, Chi, are you okay with us posting up your question later?
Sure.
All right, thanks so much for your question.
In the end, take your time. This is a marathon, not a sprint. Don't treat this as a casino. This is something that takes time. You have to grind it out every day.
All right, I'm going to go ahead and bring up our next person asking a question. Thanks so much, Chi. Hey, Edwin, how are you? Do you have a question?
Yeah, sorry. I think there's just lag when you come up as a speaker.
No worries. Oh, yeah, are you okay with us posting this later?
Yes. So, one question I have that you keep thinking about and like you had trouble understanding when I first started investing was maybe the idea like what like really determines the price of a stock, and like what causes the price of a stock to either fluctuate up or down.
Sure. So the stock market, as a market, it's what we say is forward-looking. So all of these prices, all the information that's baked in, looking out 6 months into the future. So what really is these movements is, one, you have maybe like something like an Apple. It's a little older now, but they've been around for a long time, and they keep coming. They have history of coming out with like their iPhones. So you can kind of build models around these, and you get an idea of how much revenue they may be able to make. So they think, okay, well, let's just say Apple grows 10% every quarter. So you can kind of there's formulas where you can like extrapolate into the future. So if all of a sudden maybe Apple comes out with some new product that nobody heard about, some secret product, that might cause their price to spike because that information wasn't baked into the stock price just yet. Or vice versa. It's like their earnings come out and they only made half of the revenue that the analysts expected. So that'll cause the price to come down. It's not exactly a simple answer, but it's essentially specs for making revenue 6 months into the future.
Yeah, I think that's a good way to capture it, Ali. It's the potential, but that potential can be measured in many different ways depending on the type of company, the size, is the industry that they play in, the market, right? So a Warren Buffett is going to value a certain company one way, and his way is more traditional. So it's, what are the high confidence cash flows that I can predict in the future versus a Tesla, who their cash flows are nowhere near, something like a Microsoft. The value placed on a Tesla stock is mostly on speculation that they are going to dominate, certain new markets that are not quite defined yet. So there's several ways to value it, but I think Ali summed it up correctly in saying that it's really the potential profits that a company can make in the future,
or not make.
There's also
like if they have a competitor that's coming out with something that's better than a substitute product, how it impacts their.
Yeah, I can give often like piggybacking off your Tesla example. Tesla's now valued larger than I think the next 10 or 11 or 12 auto manufacturers out there, and they don't produce nearly as many cars, but it's the potential that they their technology will be able to meet that at some point in the future. If they start to stumble along the way or competitors start to come in, their stock price could come down dramatically. To give another example with GameStop is going through a huge transitional phase right now. To anyone who's ever shopped at GameStop, you kind of have an idea that, it's not a big money-making machine. There's that joke that it's like, oh, I bought this for $200, and like best I can do is $250. I'll give you $2.50, right? The company right now, its current price, it is not. They don't even have the assets to back up, the current stock price. There's a lot of speculation here. So fundamental analysis, all of these things go out the window, and GameStop is causing a lot of problems because all of these fundamental analysts, people like Warren Buffett, they're like, well, this doesn't make sense. And what people don't understand is there's times in the stock market where common sense has no place. This is speculation, this is hysteria. And this is why you should not become emotionally attached to a company or just, blindly say, I believe in this company, because it's just a company that owes you nothing. And whether or not GameStop will be able to transition into some new e-commerce or tech company, that remains to be seen. But as of right now, if you totaled up all of the physical assets they have, it's not worth the share price that it's currently at. But if you're going to trade it and you think you can make money, or if you can make money shorting, going long, you have to treat it as that's all it is. It's a trade, and you have to suspend all common sense.
Do you think at that point it becomes more of like a supply and demand factor into the price?
It can, but those things are difficult even for like professionals to discern. So in your case, you're talking about kind of things that it's not as important. We always say price action is king. So, if a stock is going up, buy it. You can't really argue. Short sellers get stuck in positions because they're like, oh, this is a horrible company. GameStop doesn't have, any assets. Why is it worth this? We'll short the hell out of it. Stock keeps going up, and then they have to cover their shorts. They get blown out. We always say, do you want to be right or do you want to make money? You can be right, but you can still lose money. Just thinking that, okay, well, this doesn't make sense. But like I said, stock market doesn't make sense because there's human beings as individual actors, and there's emotions involved. And when people get emotional, common sense goes out the window.
Yeah, and I think another really good example of some odd stock movement that it just doesn't make sense if you're looking at the fundamentals was Hertz, right? So Hertz was bankrupt, and people were still buying it.
It's actually completely went bankrupt.
Yeah, so something like that, like if you were an analyst looking at this and thinking like, oh yeah, this company is already completely bankrupt, and yet if you look at the stock price, like it was just going up, and I'm reading this article, it had a 900% spike. It's just absolutely ridiculous. Yeah. So sometimes you'll see things in the market that you just really can't explain, and it's really just like Oliver said, like hysteria and hype. And at that point, I think when it comes to a stock like Hertz, it's just like people are just playing chicken. Like, you
Yeah.
just don't want to be the last person holding the bag at the end of the day, right? So there's
We
different answers.
actually had a joke about Hertz specifically, because it was like, if you bought Hertz 2 days ago, you'd be up 100%. If you bought Hertz yesterday, you'd be down 50%. So, that's like, those numbers are ridiculous to begin with. But I mean, like, great if you made money, but if you just lost half your stack, you're pretty much, it handicaps you quite a bit.
Yeah, so I guess to answer your question, Edwin, or I guess to expand on what you were saying, the value of a stock is supposed to be what the perceived value of that company is, and what people think may happen to that company in the next 6 to 12 months or whatever. But that's not always the case. Like we said, like with things like Hertz, where it is just a lot of hysteria and hype. So sometimes it's just hard to explain.
Yeah, it's willingness to pay.
Over time, the markets will settle down a bit. Like the markets go through these cycles where there's extremely active moments like right now. And, leading up to, I think it was 2018, 2019, it might take you an entire week to get the gains that we're getting in a single day. So over time, all of these things will start to, like fundamentals, common sense will start to come back in. But oftentimes it's after like a major downturn, you wipe out a lot of people in the market, and that's when it starts to quiet down, and people start to actually go back to that fundamental analysis.
Yeah, great question though, Edwin. So I think I saw one more person have their hand raised. D'Angelo, I tried to move you up, but I don't think you want to ask your question. But
yeah, I'm sorry, I was doing something else.
No worries.
I have 2 questions. Is that okay?
Sure, go ahead. We'll make you the last one.
Okay, cool. The first one is, I recently read an article from CNBC that said millennials need to save about 40% of their income in order to retire at age 65 comfortably. I was wondering, what are you guys' opinions on that? Like, how do you determine how much you need to be saving to retire where you want to be?
I think
my second question.
Do you want to ask your second one first, or you want me to answer this one first?
They're kind of related. I don't know.
Yeah, absolutely.
Okay, so I'm a finance major, accounting minor, and we're studying like capital asset pricing models, beta, asset allocation, that kind of thing. So I was wondering, like, how practical is that to do in the construction of your own portfolio, like personally or professionally? I think some of you guys were personal finance managers.
Yeah, so I think we're actually going to talk about asset allocation next week. We're going to save it just in our purpose of time. Ask me your first question again.
Okay, I read an article by CNBC that said millennials will need to save about 40% of their income to retire comfortably at like 65.
I'm not a big fan of those articles, just simply because every person's different, right? Like if you're making $150,000, but you're spending $175,000 a year, I mean, it's obviously you're not going to be able to retire ever, right? But on the other hand, if you're making $150 and you only spend $30,000 a year, then you have the ability to save over 40%. It really depends on what kind of person you are. My advice is, I know in Fidelity they have tools that will help you, and I'm sure pretty much any of those brokerage firms are online are going to have tools. But pretty much what you can do is just put in how much you make, how much you're spending, when you want to retire, and at the end of it, it'll spit out how much you should be saving. Right now, I know as life goes on, things are going to change, but that's why it's also important to update that information, because as it goes along, you're going to be able to see, oh, I am on track, or, hey, I need to start saving a little bit more than I currently am. Does that answer your question?
Yeah, for the most part. I've used those calculators before, but it's just kind of hard to determine if you're on the right track based off age or income, things like that.
You always have to adjust to your specific situation. Those things are a really good way to start, but like Jay Lou said, it's like you always want to update it no, there's no way for us to like see into the future. Like we may go into a downturn tomorrow, which would change a lot of things, right?
We also don't know what inflation is going to be in 30 years, right? I mean, there's way too many variables.
If any.
Yeah, there's too many variables to tell you, like, hey, this is the set number that you need to be saving. That's why I'm not a fan of those articles.
So I would say that there are a ton of variables, but those tools do offer you flexibility. So you can input very conservative assumptions. But again, it is going to be unique to every individual because a lot of those tools are actually they make a lot of assumptions, right? So they'll assume that you are making a certain amount, you'll have some steady pay increase, but that might not be your plan. You might plan to just say, hey, I'm going to kill it for the next 15, 20 years, and then I'm going to chill for the next 20 years and go take a nonprofit job that I love. Right, so that you just need to incorporate your kind of life goals and plans into those tools and make it realistic for you.
I'm glad you said that, Ben. Yeah, I think whenever you're inputting data into those tools, definitely be conservative in your estimates, right? Because it's only going to be you that gets hurt in the end.
They're on the side of caution. Always like, if anything, like just try to save more, because I mean, who's going to be mad if you have like an extra amount of money that you weren't expecting to be in there, right?
Yeah, I think that what everyone already said is absolutely right. Like, it really does vary from person to person. It's just going to depend, what is your current income. Like, 40% of someone's income that makes $40,000 a year is obviously very different than 40% of someone's income that's making $100,000 a year, right? Even that in itself is going to that one variable has already completely changed your number.
Huge, yeah.
Yeah, and then, after that, it's like, what are you spending? Like J. Lou said, it's like, if you're the type of person that's always spending more than you make, like, you're never going to retire. It doesn't matter what percentage you're putting in if you're always overspending. But if you're someone that's pretty frugal and you live within your means and you're only spending $20,000, $30,000 a year or whatever it is, then yeah, like, you could probably put a lot less money into your retirement and be able to retire at a reasonable time. So it really just comes down to, how much are you making? How much are you spending? And I kind of say this a lot when I compare investing to other things, but I think it's a lot like exercise and dieting and fitness. It's like calories in, calories out, right? Like, it just depends. Like, how much are you spending and how much are you making? And that's going to determine, like, okay, how much money do you have that you can actually put away for your retirement? And then what do you want to do in your retirement? Are you the type of person that's going to want to travel the world and, like, live abroad, or are you the type of person that's like a homebody and you just want to stay at your house and you just want to relax and watch Netflix? Like, it really just depends, like, what type of retirement do you want to have too. There's just a million things that you have to think about when it comes down to how much you need to save for retirement. And then there's also the community of people that are like the FIRE community, the Financial Independence Retire Early. And so their savings goals are going to be completely different than someone that's planning on retiring at the typical age of 67. Like, those people are trying to retire at, age 40 or something. So the amount of money that they're putting into their retirement is going to be massive compared to the average person that's like okay with continuing to work and then retiring at 67. So I think it just comes down to what your goals are and what type of life you want to live later.
I think those are all definitely fair points and things to consider. Recently, I've just been going with the goal of 10 to 20%, try to get up to that range, and then figure it out from there based on what kind of lifestyle you want to live in and everything else. But thank you guys for answering those questions.
Yeah, absolutely. And there's so many great tools out there. Like, there's a million different calculators that you can use. And you can play around with the inputs. You can see, like, okay, if I put in 30% of my income every year, where does that get me? If I put in 40%, 50%, whatever. So just play around with the calculators that are out there, and I know there's a ton of them. I recently started using this website called Personal Capital that one of my friends told me about. If anyone hasn't heard of it, it's kind of like Mint in that it tracks all your spending and you can see how much to budget for different things, but it also tracks all your investments as well, and it has like a retirement planner, and it tells you, okay, like, if I'm saving, this is how much I already have saved today, and if this is how much I put in every year, And if this is how much I think I'm going to be spending in retirement, and this is the age I want to retire at, like what are my chances of that happening? So, I mean, there's tons of cool tools out there. That's just one that, like I said, I just recently started using, and I think it's neat because it does show you asset allocation, and it has like those budgeting tools as well as kind of more like long-term investing tools. But yeah, I'm sure there are so many things out there that you can use, and a lot of them are free. Like this thing is free. But yeah, I think that's it for today. We're gonna go ahead and stop the time since it's a little over an hour now. But I hope we were able to answer your question, D'Angelo. Thank you so much. That was a really great question. And like Jonathan said, we are going to touch on asset allocation next week as well as some other topics. Oh, and D'Angelo, are you okay with us posting your question online later when we post up the recording?
Oh, absolutely.
Great. Well, thank you so much. Everybody, thank you in the audience for attending. I hope you guys gained some value from this discussion today. And again, thank you to all the speakers. I know you guys are all my friends, and I kind of forced you to be here, but thank you so much. I really appreciate you guys so much.
Thanks all.
Yeah, and for real, Ben, I'm putting you last next time because I can't, we can't follow your MIT MBA.
I'm ready to nerd out with D'Angelo next week on CapM.
Perfect.
Oh, I'm looking forward to it.
All right. Well, thank you so much, everybody. Y'all have a great rest of the week.
Thanks, everyone.
Thanks all.
Yeah, have a good week.
Thanks, guys. If y'all had questions, please write them down. We'll be happy to answer them.
Oh, yeah.
We ran out of time today.
Yeah, if you have any questions, please, you can send us a DM on our Instagram. Laura and I have an Instagram called Finance Pillow Talk, same name as our YouTube channel. Just Finance Pillow Talk, all one word, and just send us a DM. We'll write down all your questions, and we'll try to address those during next week's session. So thanks again. Have a great week.